everyone, and welcome to Unit 2. We're going to concentrate on learning the language of investing in business, because being able to understand finance is the only way you'll understand investing. The structure of this unit is quite simple. In this episode, we'll learn some of the basic terminology used when investing. In later videos, we'll cover the terminology in business, like on the balance sheets, as well as the common metrics and formulas used when researching. We'll also have an episode dedicated to teaching you how to make sense of financial newspapers and TV shows. Now, I want to make you aware of the differences between investing terminology and business terminology. There isn't really a clear-cut line, but let's say that investing is the language you hear on shows like CNBC, while business language is found more on company balance sheets and more official documents. Let's jump into investing terminology, which is what I consider to be the less complicated of the two branches. In Unit 1, we learned about the basics of stocks. A broker is simply someone who agrees to buy or sell stocks from you. There's always a finite number of shares offered to the public by a single company, so there must always be a proper buyer and a proper seller of the shares. That leads us to the bid-ask spread. The bid is simply the highest price a buyer is willing to pay when buying a security, which we'll define shortly. The ask is the opposite, meaning the lowest price a seller is willing to accept when selling a security. So whenever you buy or sell shares, the price used to perform the transaction should be between the agreed upon bid and ask. The combination of the two is often referred to as the bid-ask spread, where the spread is the difference between the bid and the ask. As promised, here's the definition of a security. It's just any type of investment that represents ownership, a right to ownership, or a credit relationship. Stocks, bonds, mutual funds, and options are all examples of securities. Yield is an important, yet very simple concept. It's just how much an investment grew over a given period of time. You can say, my investment in Apple stock provided a yield of 30% last year. That leads us to the idea of volatility. An easy way to define volatility is by looking at how much the stock has fluctuated over time. If a stock has stayed relatively stable in comparison to the S&P 500, then it's considered to be not very volatile. If the stock fluctuates a lot and it's not very predictable, then it's very volatile. The term cyclical is also applicable in this scenario. Cyclical is just the cycle of prices. If a stock is cyclical, then it has a habit of, say, going up for a while, then going back down, and that repeats every year. That's relative to the idea of a bull or bear market. Those terms can be heard frequently on shows like CNBC, and all they refer to is the sentiment of investors. If most investors think the stock market will rise over time, and are therefore buying lots of stocks, then it's called a bull market. Inversely, if the investors think the stock market is going down soon and are selling their shares, then it's a bear market. Simple to understand, yet crucial to be aware of. And that just about concludes the investing terminology video. I know it might not seem like much, and it's not. Most of the terminology we use when investing is what I classify as business vocab, so you can definitely expect that video to be much, much longer, and much more complicated too. I hope that I didn't bore you too much with this video, but trust me, the interesting parts are coming. To get there, we must endure this vocab. Thank you all for watching, and I hope that this video, albeit short and full of vocabulary, was helpful and informative. Next time, we'll take a look at our first balance sheets and learn the most important terms in the business language. Stay tuned for that, and be sure to like and subscribe. Thanks for watching, and keep making money.